Hi, and welcome to my monthly Market Insights video. My name is Dan Timotich. I'm a managing principal and one of the portfolio managers at T2 Asset Management. Before we get started, I just want to remind you this video is for educational purposes only. Opinions expressed in this video are mine and do not reflect the opinions of other portfolio managers. You should always consult with a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, let's jump right into the numbers. We had a good month in August. All U.S. stock markets have done well. Russell 2000, the small cap index, did the best, not only in August, but also for the year. As you can see, it's outperforming the large cap indices. The struggles continue to be in the international as well as the bond markets. Turning to sectors, you might see a new sector there called communication services. This one was launched in mid-June. It represents companies, media companies primarily, like Facebook, Google, Comcast, Verizon, Disney, Netflix. So the year-to-date number there is since mid-June through August. But overall, sectors did well. It's led by technology and discretionary for the month, as well as for the year. As you can see, they're both up about 19% for the year, so they're doing really well. The general takeaway here is that investors were really rewarded if they had U.S. over international stocks, if they had stocks over bonds, and if they had risk sector exposure. All of that has done really, really well for the year. Before we get really into the changes I made for August, I just wanted to let you know and cover some of my investment models and how my philosophy works. Each of my models is divided into two components, a long-term allocation and a short-term allocation. The long-term is designed to be fully invested for longer periods of time, and the short-term allocation seeks short-term opportunities for capital appreciation. If you kind of look at it, the left-hand side here, the long-term allocation is the core holdings based on risk tolerance and tends to be fully invested. It's typically a 12 to 18 month outlook based on macroeconomics, the current market cycle, overall fundamentals, and because of its longer term in nature, it tends to be lower turnover. The right side, the short-term allocation gives me the opportunity to go globally or to make some sector changes. It offers flexibility to own other asset classes, including cash, bonds, stocks, and alternatives. So that being said, I did make some changes in August. I still have an overweight to small caps, but I did trim some of that exposure, added some a small position in financials. I moved out of staples entirely at the beginning of August. We had a really nice run since I bought it back in May, and I wanted to lock in some gains. I trimmed some exposure to tech, but I do still have an overweight there, and I added to the existing positions I had in financials. I moved out of international exposure completely and added a small position in energy. The net result of all the changes we made in August increased our cash position to about 15% in the all core equity portfolio, all stock portfolio. If you guys are familiar, most of you are familiar with my four-part framework, looking at the economy, earnings, valuations, and markets. So let's just jump in. The economy, Atlanta Fed estimates GDP to be strong, 4.4%. The ISM numbers from August are the highest since 2004. Broad-based expansion across all industries, so generally very positive on the economy. Earnings, companies are pretty much done reporting, and 80% of them have reported positive earnings surprises. 72% have reported positive sales surprises, and overall earnings look strong and continue to remain pretty high. So I'm very positive on earnings. Valuations, the stock market has recently hit its all-time high, and valuations are a little bit more expensive now than they were. Bond spreads remain tight. The 10-year Treasury still seems to be hovering around that 3%. It gets up there and then it sells back off. So all in all, valuations are not cheap. They are justified, as I said in the past, but they're still a little bit on the higher side. So generally neutral. Turning to markets, stock market is still holding its uptrend, but I do expect volatility to pick up not only from a seasonality perspective, but given that we are only about 2 months away from elections, so I'm sure there'll be some additional volatility to pop up. Okay, what should we do now? Keep some dry powder. As I said earlier, I have about a 15% position in the stock portfolio in cash. I think there'll be better entry points in the next month or so. It's a good time to reallocate your stock exposure. A lot of these sectors have run up significantly, and you may be skewed a little too aggressively. So I think this would be a good time to not only rebalance your stock portion, but probably your overall bond portfolio as well. So take a look at everything. Make sure you have the right exposure and the exposure that you're comfortable with. I still like to overweight the U.S. stocks over international stocks on the bond side. Sound like a broken record. I've been talking about this for about a year. I like floating rate bonds over fixed rate long duration bonds. I still like credit risk over interest rate risk. And I always believe in holding diversified low cost exposure across all asset classes. Hope this video was helpful, and remember, if you need any information on any of my models or just want some clarification on some of the things we covered here, just give me a call or shoot me an email and I'll be sure to follow up with you. Thanks again for watching, and we hope to see you next month.